These are the topics I actually have in my PowerPoint, and I will try not to wander and try to keep within it. Basically, I'll talk about the reality of financial flows, the impact of financial liberalization, and the difference in the paradigms. Promoting, then I will say that the main problematic I will talk about is promoting domestic accumulation and investment. I talk about policy space. I talk about, this is about finance, right? But this is how I want to talk about it, domestic demand, and I'll talk about all the other things that I think would be interest, illicit financial flows and tax cooperation, orderly, actually it should be called disorderly debt markets. These are external debt issues. And then I talk a little bit about macro concerns. I'll talk a lot about, let me see if I can make this work. I'll talk a lot about capital controls in this area, right, which I think is a very important part of macroeconomic management, controls over the capital account. Okay, so this is one reality graph. Actually, since 2000, the developing countries as a group have been net financial investors in the developed country markets. These are in $1 billion, and the number here is like 800. This is actually developing countries in total. Africa is the green one. So on a net basis, after you count everything that is flowing in and out, including the payments for debt, the lendings to Africa, Africa has basically been getting a negative inflow. Negative means Africa as a group is a net investor in the financial markets of the developed countries. Okay, of course the biggest example is China, right? Because China has been buying treasury bills in the U.S. in order to protect itself from sudden stops and sudden changes in private investment. But the situation here is that many countries are actually forced to invest very large amounts in international reserves because of the instability of the private sector flows, right? It's not really the public sector flows, but the instability of the private sector flows. So the reality here is that we are net investors. In effect, there is no net, in financial terms, there is no net money coming into developing countries as a group. I won't take too long. These are the numbers. These are the Africa numbers. So negative means that Africa is a net investor in developed country financial markets. There's a breakdown for sub-Saharan Africa. It's a little bit more positive because sub-Saharan Africa does not run very large current account surpluses, right? When you run current account surplus, a lot of your surplus tends to be invested in financial markets abroad. This is the other thing. What is since in 1990 there was what they call the Big Bang thing. Everybody started to liberalize their capital account to remove capital controls, right? And this is a graph that shows the red line is how much real investment has actually happened. This is what economists call gross fixed investment, right? Gross domestic fixed investment. These are investment in real machines, things that create jobs, in buildings, in transport, etc. Not investment in other financial assets, right? And what it shows is that more or less the level has stayed high. This is for the whole world, right? This is including developing countries, right? Developing and developed countries. And this is the scale of the flows of financial capital around the world. And what the graph, what I want the graph to say is that there has been a lot of playing around with the financial flows, but the level of real investment, the kind of thing that we are very interested in, what I would call what you might call accumulation, is actually barely moved, right? And it has not actually improved. So we have been told the story that we have to liberalize, we have to remove controls on capital account, and we have had a lot of flows. We have a lot of activity, right? But the actual real investment, even among the developed countries, has not really changed very much, right? It's moved up a little bit, but then what you had is the crash in 2007, 2008, when the financial markets crashed in the developed countries, right? This is not, they cannot blame the developing countries for this anymore. Basically, developing countries were bystanders in this whole thing. But of course, there were also bystanders that were adversely affected, right? So this is the reality of financial flows. Financial liberalization has not increased net inflow of financial resources to developing countries. It has created the greater instability in financial flows. And private flows are still positive, but they are very unstable, right? This is for developing countries in general. This is 2007 to 2008. What you can see is there was an inflow of 1.2 trillion, an outflow in the same year of 825, and a net 460, right? So in effect, you can still say that private sector on the net is bringing in money into the developing countries. But if you were a finance minister or if you were a central bank governor, you would worry every month where the net would lie, right? And actually, what is actually happening is that we are now walking into a situation where the flows are going to reverse, because the United States Federal Reserve will raise interest rates. There is not much demand on the part of Europe, etc. So there are actually debt problems that are beginning in developing countries. So for me, what the problem is, well, one way to say is how to translate finance into real investment, and I question that. But actually, and the reason is that there is a paradigm issue here. The paradigm issue here is between the Keynesian view of what causes investment and the non-Keynesian view, right? Or even a Marxist view. Keynes didn't like Marx very much because he didn't like his style of writing, but they actually had the same, they used to worry about the same things like underconsumption and underinvestment and all the stuff. But investment actually begins with somebody deciding to take a risk, right? It doesn't begin, because the normal way in which you think of investment is this. Somebody puts together a pool of money, and that pool of money then gets allocated in the most efficient way, looking at rates of return, among competing projects. That's not actually how investment happens. The Keynesian view of how investment happens is mobilization, right? Some private sector or some enterprise or somebody decides he's going to invest and is going to put the resources in it and find the resources that are needed to make that investment. So there is this line here is questionable in terms of the paradigm. It's the wrong paradigm to think about finance. It's the wrong paradigm to think about finance domestically. It's the wrong paradigm to think about finance internationally. It's the big secret that bankers want to keep from us. They don't want us to know. They think that they are just allocating according to the most efficient and the most promising project, but actually they themselves are the private financiers and central bank governors, right? They have the capability to create liquidity. They have the capability to finance projects. Somebody just has to take the risk, and that is why for a Keynesian, this thing about demand, effective demand is very important. Effective demand is somebody willing to take the risk, somebody willing to spend, somebody willing to take a long-term investment, somebody willing to put in some infrastructure project, right? The state and to plan and all that stuff, right? So this is the first superstition that you want to get rid of when you talk about finance. So there are, of course, institutional factors. There are state enterprises that can actually create domestic demand. I mean, domestic demand in terms of investment. There is development banking, which is very important. It has been rehabilitated. Used to be, the World Bank is a development bank, right? They used to go to all the countries in the world and tell them to close down their own development bank. They ended up being the only development bank, plus all kinds of advice about what to do about your economic policy. And the other part of it is policy space, right? Policy space is your ability to decide whether you want to invest in something. You want to take, whether it's the state sector or the private sector, whether it wants to take a risk in something, right? So I put here two reasons why policy space could be restricted. One is from international treaty obligations or from policy conditionality, right? You have an expenditure ceiling that you cannot breach. The other thing is really basically from being quite open. I mean, for example, having a low level of tariffs or open capital account. I mean, I cannot take too long. Okay. So what is the issue? Well, the issue is whether you can manage to make, you can have domestic demand so that you can grow faster and that you can invest and grow faster. These are some graphs that we used to, when we used to make in DESA in 2010. And this is the graph of the lost decade. This red line is the same, this line, this gray line is the same line as the line in the very first graph about world investment. So if your investment rate is below world investment, you are growing less than world investment, right? So this is Latin Americans' lost decade, where they were investing less than the world investment rate, and that's this is the lower middle income Latin Americans. For all of that time, they were below the world investment rate. I don't have time. I have to go through these graphs very fast. This is Asia, right? And this is Southeast Asia. We had a crisis in '97. The capital. We had a lot of capital flows coming in. They suddenly stopped, right? And then we had a crisis. We were investing higher than the growth rate, right? Higher than the world investment rate. And then we had a crash, and until now we're still trying to recover back to the world growth rate. And this is China mainly, right? This is the lower middle income. China is poorer than many of us Southeast Asians. We cannot help it, but they happen to be poorer than us, but they're investing a lot in Latin America. China maintained capital controls and kept their investment rate higher than the world growth rate. And of course, this is Africa, right? So African growth rates have been below the world real investment rate for all of this period. We already talked about structural adjustment programs, etc. Right? So basically, one way to look at structural adjustment program is they will kill domestic demand, right? To the extent that they will kill the state, to the extent that there are state enterprises that will not be available, to the extent that they kill the domestic private sector, they will kill domestic demand. The other thing about this crisis, and the overall financial crisis imposed, is that every time a crisis happens, what actually happens is that the employment rate goes down. Malaysia is not as bad, right? They had a crisis in '97, '98, like the rest of Southeast Asia. This is the rate of unemployment, right? This is the rate of unemployment in the economy, because this, we want to put emphasis on employment. The unemployment rate in Malaysia went up a little bit after the crisis, but what actually happens in some countries is that the unemployment rate increases and does not recover very fast. So this is Indonesia, I think, Indonesia. So this is the unemployment rate before the crisis, and the unemployment rate has gone up. Because what happens is that the crisis does all kinds of reforms and structural adjustments that are forced on the economy. I'll not go to this. This is Brazil. See, this is what happens is the unemployment rate increases after a financial crisis, after a debt crisis. This is why debt crises are very important junctures. And this is, that's Brazil. I think I had Turkey, but okay, I don't have, okay. Okay, so let's talk a little bit about policy space. Well, just to tell you, if you have been attending the negotiations in the UN, policy space is a very sore negotiating point to the developed countries. They don't like it showing up. At the most, they will allow it to show up in one paragraph, and then they'll try to put all kinds of qualifications. The G77 has to put its foot down just to put policy space in, right? And we already talked about what finance is, right? Finance, you require policy space in order to undertake investment. So so I said there were two things where policy space is restricted. One is international obligations, policy conditionality. In free trade agreements like EPAs, you have government procurement requirements. Government cannot have a very low threshold in which it has to allow foreigners to bid on government procurement projects, including AIDS medicine. Competition policy. Actually, in the TPPA, which is being negotiated in my region with the United States, there are proposals for disciplining what state-owned enterprises do. There is trade policy, EPAs, export taxes, tariff binding to zero. When I was listening to the earlier discussion, I remember Nigeria was sort of convinced that it didn't want to sign the EPA, right? because they had a general equilibrium model that showed that they would have a negative impact. The problem was that the other countries in ECOWAS, is it ECOWAS that they are with, we're going to sign, right? So this is, the South Center works quite closely with the AU about the EPA issue. And one of the things that I wanted to bring up with you was our own personal experience that countries have a hard time discussing to what extent these EPAs will will reduce their ability to industrialize and sign up on their own because they have their own export. They want to protect some of their exports into the EU market, right? EPAs actually prevent export taxes, and they require tariff binding to zero of 80% of the tariff lines, right? So the first impact of an EPA is that it will reduce your public revenues, government revenues. And secondly, if your 80% includes the, I have so much to do, but okay. Then you will lose protection for many of your competitive industries. Okay, and then all kinds of investor protection. So I've gone too long. Okay, so openness of the economy is one thing about policy space. This is very important in many emerging countries. I'm not sure this is as important for an LDC, but portfolio investment takes up to 40% of the domestic bond and equity market. So what does it mean that you have a portfolio investment from a non-resident investor? Well, the moment the interest rate goes up somewhere else, the money will fly out, right? I mean, it's not as if he's being mean to you, but he has to worry about his quarterly report. I mean, and the quarterly report of the investment managers. There are very high. This is one big reason why, on a net basis, developing countries are net investors in the developed country financial markets because they are buying international reserves, right? They cannot be used for development of the domestic financial sector, right? They could have been balances in the domestic banking system, and they could have been then turned around and you take a risk and you have investment projects, but you're not able to do it. Now let's see. Okay, this is about the capital control. Maybe if I can just end here, Jeke, then we can. So capital controls, the IMF view is that all of a sudden 2 years ago the IMF changed its mind about capital controls. Capital controls about the capital controls are the following. I want to buy a real estate, a lot in the United States, right? And therefore I need money and I want to buy that lot, right? So a capital account transaction is a asset-to-asset transaction. It's different from being, I want to travel to the United States. That's not a capital account transaction. I want to travel to the United States. I want to buy my airplane ticket. That's not a capital account transaction. But if I want to buy an asset abroad, that's a capital account transaction. If I want to sell an asset to a foreigner, that's a capital account transaction. The IMF view is that you can ask the person why he is needing to buy a lot in the United States, right? But you cannot stop him from doing it. And you can only impose a control only as a last resort if you have a balance of payments crisis, right? So the IMF view now, at least this is from the last 12 months, is that they're now willing, and this is the kind of thing that they're taking a position on in Greece, they're not willing for their resources to be used to pay off existing creditors. See, the other way that instead of buying a lot, you can pay off a debt that you have overseas, right? So this is their view. We think that this is not enough, and this is not enough for you to be able to undertake fiscal and monetary policy, right? Fiscal policy is your ability to spend and according to to build the social protection issue, social protection, social security. Monetary policy is providing financial resources to fund investment. So this is the second. The second level is this: that you need capital controls in order to undertake macroeconomic policy. Macroeconomic policy is both fiscal policy and monetary policy. Counter-cyclical policy is impossible if you have open capital accounts, right? Because if you start printing money, without a capital account control, your residents will then say, we are not sure because you're printing money, the exchange rate is going to fall against me. I'm going to buy a few dollars because then later on I can convert it back, right? So you cannot do monetary policy. If you undertake fiscal policy, the foreign investors will say, you're going to have a deficit next year, and therefore I'm going to take my money out, right? So instead of, you're unable to do this. And actually, if you have an open capital account, you have very perverse capital account reactions to many to many fiscal policy. This is one example. Many governments say we will reduce our deficit in order to fight inflation, right? Or in order, you want to fight inflation, you want to reduce your deficit. Actually, when the foreign portfolio investor sees that, they can see, oh, you're a good risk. So we want to buy your assets in the capital account, and actually you end up not being able to reduce the rate of inflation domestically. And finally, and I will stop here, to promote capital accumulation. I said the overall framework I have is what is finance and what is macroeconomic policy is about accumulation. It's about investment in real machines, real factories. With an open capital account, resident savers require higher interest rates and higher compensation for exchange rate and project risk. So if you want to increase your rate of development, rate of investment, you are actually condemning yourself to having a higher rate of borrowing for domestic projects, for domestic real projects. It also imposes the exchange rate risk on the real sector, right? Because it imposes the exchange rate risk on the real sector. When the exchange rate changes, when the money starts to flow out, your own domestic investor has a problem, right? And finally, the domestic financial sector is subject to the vagaries of the payments market, right? There are many. Actually, I have to stop soon, right? Now, okay. So, like these are 3 episodes of crisis that developing countries have had to deal with that had nothing to do with them, right? Of course, every time a debt crisis happens, the idea is you are spending too much. They told the Greeks that they were retiring too early at 55. Of course, they were lending to them anyway, right? They find some reason why you are at fault, right? But actually, all of these things, all of these ups and downs, actually happen outside of the country. Let me stop there, and thank you very much. Basically, if you want to think about what this thing is all about, it's about how do you manage a finance in control, right? We are now in a global situation where the financial capital is actually in control of many things that are decided economically. And then you still want to develop how they're going to manage that kind of a situation. I stop. Thank you very much.